What's up everybody? Welcome to the Stocks channel. My name is Cory, and today in the stock market we continue to sell off as we are now approaching a very critical support level in SPY, and we are still in a falling knife scenario. First up, let's take a look at the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, please remember to smash that like button and help these videos reach 2,000 likes. Alright, so today in SPY we were down 0.76%, and we did get the second day in a row closing below the 50 daily moving average, and we did see that level acting as resistance. So from here we are still in the falling knife scenario ever since we got rejected and broke down below our risk level at 416. So SPY is still risk off while we are in this falling knife scenario and while SPY is below 416. Now I talked about this last night, but as an investor you can accumulate the lower we go, but as a trader you need to stay risk off, and if you want to use a risk level to get more bullish, you need to at least wait until SPY can get back over the 50 daily moving average, which is currently at SPY 400. To the downside, the next level of interest we're looking for a possible downside price target is right around SPY levels of about 393 to 394. And below that, we do have the support trend line, which is going to be right around 389 to 390. Now, there are a lot of parallels being drawn to previous bear markets in SPY. And one thing I can tell you is that typically you start seeing capitulation once you break below the support trend line. And on SPY, that is going to be this level right around 389 to 390. There's a very obvious gap to the downside right around 378 and another gap right around 369. So obviously, if we do lose that support trend line, those gap fills are very obvious downside price targets. Remember, sometimes when something is too obvious and everybody can see it, the market will more than likely do the opposite. So as we approach support, if too many people are getting bearish near support, do not be surprised if the market turns around and does a counter trend rally. So for that reason, levels of interest for support will be anywhere between 389 to about 394, and there's basically going to be a support level every $1 in that range. So treat that support as a giant cloud between 389 and 394. And then to the upside, there's very obvious resistance at 400, which is the exact level we were getting rejected from today. If we can get back over 400, then we could start rallying up to the resistance trend line, which is going to be right around SPY 411. So you need to determine how you want to manage your risk. And if you are shorting this market, at this point, you're basically trying to short the whole, which doesn't guarantee you won't make money, but it's getting less and less likely that you're going to make money shorting the market the more and more it continues to the downside. And as you can tell, we did close below the lower Bollinger Band for the second day in a row. So it really doesn't matter which direction you're trading in. What matters is that you're managing your risk very tightly no matter which direction you're trading in, because this is a very volatile market, which means we could see monster bounces to the upside or full-blown capitulation. It's really anybody's guess, and that's why I always suggest following price action. That capitulation scenario is going to be a lot more likely below 390, and the bullish scenario will be a lot more likely above 400, so expect a whipsaw of the price action in between that zone. The volume did drop off a little bit today from yesterday, but not enough to say that it has any significance, so I wouldn't pay too much of close attention to that. On the Nasdaq 100 triple Qs, we were down 0.58%, and the triple Qs are currently testing the support trend line, and yes, they did squeak a close barely below that level, so it does look very likely that we could see a retest of this support zone right around 296 to 297. Just like SPY, we saw the triple Qs rejecting from the 50 daily moving average, and we did see a very bearish candle closing at the low of the day, but also below the lower Bollinger Band. So things are getting overly extended to the downside, so be very cautious if you are shorting the market near support in this sort of overextended to the downside condition. You could try to get risk on around this risk level at 296 to 297, or wait until we break back over the 50 daily moving average, which is currently sitting right around 305. And if we break above 305, we should see a retest of about 314, unless we get an extremely bearish scenario where we just continue to see that waterfall wave of selling, which is more in line with a capitulation scenario. Remember that capitulation has no rationality, it is full-blown panic selling. So while it is possible we do see capitulation, it is going to be extremely rare and usually does require something that spooks the market. So at this point, with the triple Qs only going down 0.58% today, I do not want to scare you into thinking that we're about to capitulate, so please do not misinterpret what I'm saying. Just keep in mind, if we continue to see the falling knife, eventually the high volume panic selling can come into the market, and it's just something to be aware of. On the Dow Jones, we were down 0.75%, and again, the Dow Jones is closing below the 50 daily moving average and coming into that next support level right around 315. This 315 level should be very strong support, so if it fails, that will be extremely bearish, which is going to open the opportunity for the bears to have a straight path down to the gap fill just below 307. So on a break below 315, look for the gap fill to the downside. Otherwise, look for the bulls to try to make a stand around 315 and try to bounce back up to the 50 daily moving average at 321. On the Russell 2000 IWM ETF, we were down 0.61%, and as you can tell, the Russell 2000 is still looking relatively the strongest, still closing above the 50 daily moving average and still closing above this support right around 183. It's going to be a lot more risk off below 183 for the next support at 178, but if we do get a bounce from here, we could bounce all the way back up to our risk level at 191, and above 191, it will look like the downtrend is over in the short term and we are getting the bullish breakout. So watch that strong support here right around 183, and if we start to bounce, look for resistance right around the 190s. On the ARKK ETF, we were down 0.07%, so ARKK held up relatively strong today while the rest of the indices were selling off. ARKK did fairly well, going absolutely nowhere. But we are still getting rejected below that resistance at 43. We are still below all the moving averages, and we are still below the resistance trend line, and we are still in a bear market as long as ARKK is below 47. Next downside support levels will be right around 40 and then 36.5. So do respect the fact that this is still in a bear market and we're risk off while we're below 47. But in the short term, if we bounce and break above 43, we could attempt to go fill that gap at 47 and then find resistance. On the VIX, we were down 1.3%, so we did see the VIX dropping with the indices, which is telling us there's still not a lot of panic selling going on, which is less likely to see capitulation. So don't just go panic selling just because the markets are reaching critical support. Wait for the VIX to show some type of panic and wait for a break of support in the price action. We're risk off while the VIX is above 24, and we're getting more bullish if the VIX crushes below 24, and then we'll be looking for the VIX to close the gap at 21. On Bitcoin, we're currently up about 2%. Bitcoin is holding up relatively well today, and we are starting to see an increase in volume on a green day, which is definitely bullish price action coming off of this bounce at 19,500. If we fail to hold that support, look for a retest of 19,000, and a failure of 19,000, we should be coming down to the next price target at 17,000. You can get a lot more bullish on a breakout above 21,600, but overall respect the fact that we're still in a Bitcoin bear market of lower highs and lower lows. So you're only accumulating at these levels as an investor, and as a trader, you are expecting more downside. On our big tech hot stocks, we have Amazon down 1.52%, and we are continuing to stay risk off while Amazon is below 136 because we still have the chance to fully close the gap to the downside. We broke down below 128 today, so the next support is going to be right around 125 to 126. And if we lose that support, we'll be looking for the full gap close, which is currently at 122.84. So stay risk off and look for potential support around the 50 daily moving average, but never assume we have to bounce while we're in a falling knife scenario. On Microsoft stock, we were down 0.57%, and Microsoft continues to look like a falling knife. Ever since we broke down below 267, we just continue to drop, and we are still riding that lower Bollinger Band lower, which is extremely bearish. We're risk off until we can at least get back over the 50 daily moving average at 270, and from here it is possible we continue lower to test the lower support right around 251. This is definitely looking oversold, and we have a lot of gaps to the upside, so we will be looking to get very bullish in the event that we do start breaking back above resistance, but we want to wait for the price action to confirm it, which means we need to break back over 270. On Nvidia, we were down 2.42%, and Nvidia is dangerously close to retesting the previous 52-week lows, which is down here right around 145. Below 145, it looks like we're making brand new lows, and the previous 52-week low is all the way down there right around 140. So the last line of defense for the bulls is going to be this level at 145, and then who knows how low we can go from there. Upside resistance is going to be right around 161 and 165, and the 50 daily moving average right around 170. On Tesla stock, we were down 0.75%, and Tesla has its second day in a row closing below the breakdown level at 283, so we are still risk off, but there is the 50 daily moving average right around 269 to 270, and that is still possibly going to be a support level. However, if you look at the chart, this clearly looks like a double top rejection and confirmation of a break below the neckline. So I do strongly suggest staying risk off while we're below 283 because there is no reason trying to catch this falling knife in Tesla if it's going down to fill the gap around 250. So possible support levels, because we are in a falling knife, are going to be 270, 258, and the gap fill at 251. But do not think we can't go lower than that because it's a downtrend until it's not. And we are clearly breaking out of a consolidation to the downside. So there is plenty of energy to see a full-blown flush if that is indeed where they want to take this thing. In Apple stock, we were down 1.06%, and Apple did finally fully close the gap to the downside. So if you had OCD about that, you can now rest assured that that gap is fully closed. And the next logical support level is going to be the 50 daily moving average at 156. A bounce off 156 is very likely going to invite bulls to close the gap to the upside, and that gap is currently sitting at 163.56. So we are in a falling knife, so don't just assume we have to go fill that gap because we could go lower before we go higher. So watch that possible support level at 156 and stay risk off while we're below 163, or at least set your risk at the 50 daily moving average. On the financials, we were down 0.75%, closing down below the 50 daily moving average, and we are clearly starting to see more downside, which means we could start to head lower to close the gap below, which is obviously going to be extremely bearish. The industrials were down 0.84%, getting very close to potential support right around 92.5. So if we fail below that level, look for the next leg lower right around 90. The healthcare sector was down 0.64%, failing to hold this support zone right around 126. So just stay risk off while we're below 126. And if you want to get more bullish for the possible inverse head and shoulders, wait for a confirmation and a break back above 126. The energy sector was down 0.91%, and we did close the gap to the downside, and we did find support right around $79. So far you can stay bullish because we are still above 79. If we start breaking down below this support and lose the support trend line, this will look like a lower high, which means we could be heading much lower to fully close the gap at 69. So jump it back over to the S&P 500. Sometimes you need to be completely okay with being risk off and just waiting for the market to find support. And even if you're shorting this market, you still need to be very cautious because there could be a counter trend rally coming from any point once the market finds support. So whether you're waiting to take long trades until we find support or you're shorting this market, just please remember to manage your risk, because the key to trading and the key to being profitable is always having great risk management. If you're looking to become a better price action trader, consider joining the Stocks Channel Trading Discord community, where I give you all of my intraday updates and analysis. You can find out how to join the Stocks Channel Discord by clicking on the link in the description of this video. I also have Bank Trade Alerts, which is an algorithm-driven trade alert service that only trades the ETF TQQQ and sends you all of your buy and sell alerts directly via email and text message. If you're looking for more information about Bank or want to subscribe, you can click on the link in the description of this video. So thank you for watching, everybody. I hope you're crushing this market, and as always, I will see you in the next episode.